Good morning, traders. Chris Buss here with Traders Profit Compass with another edition of Before the Bell, your home for actionable pre-market content. It is 6:43 a.m. as I'm starting the video. It is Thursday, May 5th. And don't forget, run your player at 1.5x. Taking a quick look at futures. Bitcoin's off about 1%. Oil's hanging in there flat. Stocks are down. Last time I checked, about a 0.5% or so. Gold having a sharp rally this morning on the back of yesterday's rally, which was notable. I'll talk about that in a minute. Gold up about $30. Silver following. Copper is green, but not markedly so. And nat gas is up in the range of 850, so that continues to rock. Over on the macro front, jobless claims today, nat gas inventories, but the real thing is tomorrow with the April jobs report. That'll be important. Over on the earnings front this morning, Shopify, Wayfair, furniture in the mailbox, if you look at that chart, has not been working. Datadog, Crocs, Cameco in the uranium space. It's gotten destroyed over the last number of weeks. Royal Caribbean Cruise Lines should be interesting. ConocoPhillips in the energy space. And then this afternoon, Block, Lucid, DoorDash, and Mercado Libre, Meli, down in Brazil. So, I want to start off with hopefully it won't be too much of a rant, but Powell's punt yesterday. I thought it was, from an FOMC point of view, a complete disaster. And I'll share why. The Fed, Powell in particular, Lael Brainerd, for 6 months, and all the Fed governors, for 6 months, they have been building this narrative of transition between a zero rate QE environment to a rate hiking cycle starting back in November. They have a mandate to crush inflation. We've talked about, in order for that to happen, because they can't control oil and all the other supply dynamics, that they've got to work on the demand side. And the only way to do that is bring asset prices down, bring home prices down, increase rates, and withdraw liquidity from the system. And basically do whatever it takes to rid the economy of this inflation. That's, from Biden to everybody on down, sees the threat of 8 or 9% inflation, and that's the reported number. We all know it's in the teens, with oil and food and everything that they don't count is skyrocketing, and it continues to do so. So when we rotate over, talking about the Fed chair in particular, it's important to realize that job is 50% political and 50% financial. It is a political position in which you need to have financial knowledge. They're both important. When he started out the press conference, he did the right thing politically. I want to address the American people. I realize how painful this inflation is. We need to crush it, and we will. Perfect. But then, everything he said ran counter to that. Why would you tell people what you thought the neutral rate might be? Keep in mind that the backdrop is that the market has done a lot of the heavy lifting. It has jacked rates incredibly quickly up into that 3% zone. The dollar has done a moonshot. When you have a rising dollar, that is withdrawing liquidity from the system. Why would you tell people that you thought the neutral rate was between 2 and 3% when the market is sitting there at 3% and everyone's saying, oh my God, we're already at the top end of the range. We've gone too far already. If he's saying the neutral rate, or the rate in which they may stop raising rates, is 3%, and you're already at 3% in the marketplace, it's going to come off. It's not going to go higher. So I thought that was a blunder. Also, why would you tell the market that 75 basis points is off the table? We're not seriously considering it. Why do you have to say that? Why do you have to lower expectations? Keep that optionality, because now, if inflation comes in super hot for the next 2 reporting periods, and they're all sitting there thinking, crap, 50 basis points didn't do anything. It didn't knock down inflation. It didn't do anything. Of course, it didn't matter what they did on this, actual 50-point hike. It's going to take a long time to dig into inflation. But why would you take the 75 off the table and not have the market be thinking of that in the back of their mind? I thought that was a big mistake. QT, quantitative tightening. He said, well, first of all, there's a slow ramp. It starts at 45 billion and doesn't get up to 90 billion after starting in June. So it's not even going to get up to 90 billion until the September-October timeframe. Same thing with MBS, starting at 17.5 billion, ramping up to 30 billion on a roll-off. But then he says, but I doubt it'll ever get that high. So the result of all that was interest rates dropped. Asset prices went up. We got a 3% moonshot yesterday in the equity markets. Gold shot up, and it's up again this morning, $30. Why is that? Because inflation expectations have started ramping back up. So I just thought, from a communication perspective, and remember, that's an important thing for a political appointee, is you want consistent messaging. You want to know that you've got a steady hand on the tiller, and the general direction in which you're going, knowing that new data may come along that slightly alters that course, but you haven't abandoned it. And as far as that goes, I thought the communication from a Fed perspective was an F, a complete punt, belly flop, whatever you want to call it. He did not send the message in words what he needed to. And I thought that was way too soft, way too soon. If you want to get soft on your wording, you do it after you already crank up interest rates to 1.5%, 2%. And then you can say, hey, we're looking around. Facts on the ground may have changed. We're going to be cautious here. We're not going to go as fast. So I think what you're going to see, a parade of Fed speakers come out in the coming days, trying to do a cleanup on aisle 5 on that communication. But I think the cat's out of the bag. After you told somebody 75 bips is off the table, is the market really going to take Jim Bullard seriously? If he comes out in the next day or so, well, I know he said that, but 75 is really on the table because we got to get this thing up to 2% by the 4th of July. They're not going to believe him. They're just not. So, again, I thought that was a big mistake. Bottom line, now we got a good rally yesterday, 3%. I hope you were able to trade that successfully. As we've talked about before, bear market rallies are sharp and furious and have the potential to be lucrative or painful, depending on what side you're at. I think this is going to be proven to be a bear market rally. I don't think we're going. Could we go higher? Sure. We got lines on the chart to help us decide that. But ultimately, it comes back down again. That's nothing to trade off of. I think that's the narrative, and we said this even before the Fed. Have that be in the back of your mind as we go forward and as we approach critical resistance levels. And if you missed the last, down leg, I think this is going to prove to be a good opportunity for you to, anchor some shorts. Looking out, depending on the kind of trader you are, you can do everything short term, that's fine. Or a chance to anchor things on the downside out into the summer. So let's look at the charts. Thank you for your indulgence on that little rant. And you are certainly free to say, Chris is no expert Fed watcher, so I'm ignoring what he just said. Feel free to do that by all means. You can form your own opinions and or listen to others that are more experienced than I in those macro type things. McClellan oscillators ramped up right to the midpoint of the range. Not helpful at all. We'll have to see if this thing gets up to overbought, which would give us an excellent place to anchor shorts, or if it starts coming back down again. VIX got absolutely crushed yesterday, but look where it stopped. I mean, this in and of itself is a good kind of treatise on technical analysis. I mean, look where it stopped, right at support, right along this line at 25, where we've had all these reactions. Up here, we saw the lines act as support and resistance, or very, very close to it. So I think 25 is a nice toggle point. As long as we're below and trending lower, should be bullish. If we dip down below and then jump back above, that's going to be incrementally bearish. Our volatility term inversion measure both popped out of extreme fear. So that's on an upward course. Of course, we got the big rally right here. Let's jump in to SPY. We rallied right to a really important level here on SPY at 430. Notice the declining exponential moving averages. We stopped right at the declining 20-day and lateral resistance at 430. I think that is your pivot going forward. Break above 430, that would open up this 437.50. If we look at the hourly chart, we said this thing was primed with bullish divergence. Divergent low, higher PPO, higher RSI. We broke out of the downtrend line. What I've done is drop in the fibs for the entire move. You can see that we reclaimed the 38% retracement area, and now overhead we can look for the half back short, right? Down, half back short, trade location at 433.50, and here's that 437 where there is technical resistance with these prior lows. So I think this 429, 430 area, depending on, if you're on the daily chart or the hourly chart, where your pivot point is today. QQQs. As we look at it here, we had a marginal new low. We talked about this support zone, resistance zone yesterday. Recapturing 1735 was important. We talked about breaking above 322 and holding it. That was mission accomplished. So this area here, although I don't have it marked, would be your bear trap, right? You broke the low, you broke the previous low. We took a look below, but then there was no follow through. We recovered. Bears got trapped. We recovered the 8 EMA, and now we're coming up at technical resistance at 330 with the declining 20 coming right in above that at 331. I've dropped the fibs in here as well. We've got a level here, 329, let's call it. We closed right above that. Here's your prior highs on that chart. So this is a critical spot. If we were to, roll back down below, then you have an objective short against this level. If we hold above, then we can look towards this 38% retracement that comes in at 333, or more importantly, this prior low right here at 336. I think that's your next upside target. And then if we take that out, then we can look above for further upside targets. IWM. Here's where I have that bear trap identified. A break below this box should have opened the door to a lot of selling because you broke the range. It took a look below, then recovered, and then that's your bear trap. Again, on the small caps, it stopped right on a dime here at the declining 20 EMA. So that's going to be an important level to overcome, and that comes in at 194.11. And you can see it here pretty clearly. We had a gap in the chart from the other week that went from about 192.50 to 194. So we filled that to the penny, essentially. So that gap is coming off the board after this video, and then we won't really refer to it again because we've got two good levels on the chart close by. Actually, well, we've got three. Above 194, we've got a series of where this 196.50-ish type area acted as support here, here, and back here. And that's where your volume over price bars also begin to extend, showing that above 196.50, there's going to be a lot of supply here of people that got trapped in this quick downtrend. So that would be definitely a place above to look for this thing to stall. If it stalls here and rolls down, this 191.50, really important level. Why? Reject. Reject. We had a quick breakout that failed, and then we have a prior low back here and a prior low back here, right along that line of 191.50. And I think if there was a place, if you didn't, if this thing proves to roll over at 194 here, and you didn't get short, a break below 191.50 would be pretty bearish, because then it would look like that was a fake move, and then you're back below the prior lows and these prior highs. So that 191.50 is a pretty important level. Facebook has been doing really well since bottoming out. Doesn't look like a lot here, but that's what is that? At least a $35 move, depending on when you might have gotten it, but just say off of these lows, maybe even 45 if you're looking down here. The absolute low, that probably was hard to get, but even here, breaking above 190 was a technical buy recovering. But what I wanted to show you is we've got that classic double bottom with bullish divergence setup. How you project a measured move is from where the double low happened up to the first peak, which is 25.6%. It's always important to use percent, or at least I like to. And then if you were to break above that peak right here at 235, you add that 25.6%, and that rockets you well into the gap. And then you've got that classic left side of the W, inside of the W, and then right side of the W. That classic double bottom setup with bullish divergence. Let's just, if you're trying to fine tune it, let's look at the 60-minute chart. I think you've got a large, actually the largest on the board here at on the volume over price bars, and you've got a level here at 222.50 is a great toggle point. As long as you hold that, there's an open runway up to this little gap that starts at 229, and it's about $2 wide. So if you got this at any point along the way, you can stay long against 222.50. I think that would work great for you. Apple also had the divergent low, even though I didn't mark it. Here you got a lower low, RSI, higher low, PPO, higher low, recapturing these levels from below. And so right now we're at where it gets a little bit tougher with the volume over price bars coming out, and you've got this prior high just from a couple of weeks ago right here at 165.50. I think that's your level. As long as it stays above, I see it being able to get up to 168.50, where it'll get a little bit tougher. But you can see right here we had prior highs at 170 and a half. So on the upside, those would be your near-term targets. And on the downside, you drop back below 163.50, basically doing what it did on this side. And the bars don't have to be this dramatic. It's just, it broke out and then it failed. Same thing here, even if it takes a day or two, that's no big deal. If price, goes a little higher and comes back down and breaks that 163.50, that's a good short, because I think that would come back down to 159, where that would be your next volume over price support. And you can see here a lot of resistance in that area, etc. So I think 159 would be your downside target on a break of 163.50. Tesla, nice day yesterday, almost 5%. We had identified this 905 type area as support, and we also referenced the 200-day moving average on the daily chart. This little consolidation area here was perched right on the 200. We had a little weakness in the morning, and then it recaptured those levels from below. So when it broke down in the morning, and then even if you got short, having your stop, right above wherever you entered would have been prudent. And then when you got stopped out, you either got long or did nothing and waited for the Fed. You had to look below. This is the Fed bar. Look below, recapture, and then broke out of this 935 area, which I think is your pivot for today. Why? That's where this prior high was. So now on the upside, if things stay bullish, I think your next target above is 980. And if you miss this move and you're not in, and you got a back test of 935, that would be a great entry if it held with a little stop below. Or if it rockets higher, 980 will become an important level. Why? Break above, your target becomes the far side of the box here at 1020, and if it rejects, then it's going to come right back down to 935. Microsoft, back at our old friend, 290, 291. Reject, 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 reject. And here we are again. Does it reject? Just a big head fake. Notice here, double bottom, bullish divergence, but it already played out. You can just see visually the W, the breakout here projects out to 291, so that setup is over. And now it's all about 291. Does it break above and fill this gap, which would be a nice little trade? I mean, getting up to 297 for the gap fill would be a nice little trade if you got in here at 291. But if it rejects, you've got a nice line that has worked 6 times before. Traders keep doing what's been working. Shorting 291 has made people a nice amount of money. And even for us, I can't remember what we did back here, but I know we talked about shorting here and here. So both those trades worked. Now it's a question of, does history repeat itself, or is there a breakout and much higher ground to cover? And just as I'm looking at it right here, follow my cursor. Do you see an inverse head and shoulders setup? Left shoulder, head, right shoulder, and that would project way up there. I mean, just visually, you can tell that would come up and fill this gap and possibly even get back up to 316. So there's that setup buried in the hourly chart as well. But let's not get stars in our eyes. Nothing happens until 291 is taken out. Amazon, again, double bottom, bullish divergence. Here's your breakout level. Right here at the prior highs, let's call that 25, well, it's right where it closed. 25.20, let's call it. You get a breakout there. Your first target is the bottom of the gap. And then you've got a little line of resistance here at 2,700. But once it gets into the gap, you might get a more powerful move. Notice the projected level. The structure is 5% wide. On a breakout, projects 2650. So that's that for Amazon. Google, double bottom here. Here's your line of resistance right along 2457. I don't have that marked, but I showed that was the high, and we got a touch right here yesterday. That can be your toggle point. 2457. You break above that, I think you'd head up to these prior lows at 2550. Netflix underperformed yesterday, only 2%. We've been talking about this trading range. If you're in it, you'd be looking for this 212.50 at the bottom of this range here. You break above that, then you got a chance at 227.50 and then 250 at the bottom of the gap. SMH, here was your double bottom structure. There's your projected move. We talked about 240 being really important. If you were a sharpshooter, you got this touch of this level yesterday, this prior level where it acted as resistance here, and acted as resistance here. That makes it support here, while above this big candle here is the Fed candle, of course. You got a big reach back right to that level. If the turbulence, which was significant, was a little daunting, we had talked about alarming 240 on the upside. You got that breakout. You got a quick move to 247 right here. That's your toggle point for today. You get a breakout here. I'd be looking for roughly 252 and then 256 above. If you're new to the channel, thank you so much for spending some time with me this morning. You can see this is all technical driven. The Fed comments were a complete one-off. I usually don't get into that macro discussions too much, but I think in this case it was warranted. If you're into technical trading and want some very good objective levels to alarm, target, trade against, this is your place. If that appeals to you, hit the subscribe button, the alarm bell, jump over in the show notes where you can find a link to drop in your email address. Takes 15 seconds. Join the team. Get all my content, morning, noon, night, weekends, right in your email box. And I think you will benefit greatly from the content, having taken a lot of the technical burden off the table. When you get some trust in my levels, you can use all your bandwidth for your trading execution and creating the plan that you want to do, whether you're a swing trader or an active trader during the day. I think you'll have some good levels to shoot against. And as a benefit, you'll also get an invite to our trading room. Love to hear your ideas, comments, etc. And if you're listening, please leave a comment on how I can improve in the show notes or excuse me, in the comments below. I'd love to be able to do a chart for you, review a sector, whatever it may be. Happy to do it. I will work it into future content, either as a standalone video or incorporate it into the morning note. Not completely tied to Powell, but tangentially so. I think you get another bid in materials. I think commodities stay strong. Energy and oil are certainly strong. Here in the steel sector, Steel Dynamics looks like looks like a bull flag to me, coming up right here, about to not only break out of the flag, but also recapture this key level here at 89 for a breakout. And I think if you get that, then you're looking at another run towards 93, 95 type area, and then potentially a breakout. Another one in the steel sector. This is U.S. Steel, symbol $X. Big trading range, right? 22 to 29. Big breakout. And now we have the back test right here at, let's just call it 29. It's trading 30. So getting long U.S. Steel here holds $1.50 or $2 a risk. The dollar above support plus whatever distance you want to give it on the downside as a stop. I think this is primed for a bounce. I would be remiss in not pointing out that this is purely a support and resistance trade. You do have overhead resistance in these falling EMAs. You got the 8-day, the 50, and the 20 above. So those may pose problems, but even if it got to 32 installed, you should have a winner on your hands. This all boils down to, what kind of trades do you want to take, etc. Another one to look at would be Cleveland Cliffs, iron ore guys, BHP, Rio, and Vale. And I'll just close with this. Xi over in China wants to be the guy for life, right? Maybe that's 90% done deal, but how long is he going to be able to lock down cities with populations the size of Texas and of Florida? And that's not hyperbole. Look up the numbers. When you start looking at, locking down Shanghai and Beijing and Wuhan and wherever else he's got locked down right now, unsustainable. I mean, you can't do it. And so this COVID policy, there's going to be the realization that it's impossible. They just had a PMI services print. Guess what it was? 36. Lowest since the beginning of COVID back in March, in early 2020. I don't know the exact day because COVID there started really before it was here. So I don't know exactly when that date was. Sorry, I don't have it for you. But certainly the lowest since March of 2020, over 2 years ago. So is he willing to shut down his whole economy because of bad flu? I think he's going to come to the realization that that's not going to work. And the moment he either announces or whatever that there isn't a lockdown, you're going to see an absolute moonshot in all manner of commodities, oil, all that crap is going to do a moonshot. Of course, we don't know if that moonshot is in 2 hours or at the end of the summer. So, but it's out there. And as soon as that demand comes back online, boom, you're going to see everything do a moonshot in the commodity complex. So let's wrap it up there. Hope you enjoyed and benefited from the video. This has been Chris Buss with Traders Profit Compass. Talk to you next time.